How to Invest During High Inflation by Warren Buffett. Welcome back to Wealth-ology. For today's video, we will be going to talk about how to invest during high inflation by Warren Buffett. Let's get started. As financiers, we wish to put a particular amount of money into an investment and then get additional money back at a later date. However, when it comes to inflation and investing, this is a better way to think about investment. We're sacrificing some purchasing power now in order to get more purchasing power later, aka we're now giving up the ability to buy 100 meatball subs in the hopes that we will be able to purchase 150 in the future. When you consider it in that light, you're thinking about your real return, and while you might get a 20 gain on a paper investment over a few years, your real return is much lower. Before you could buy 100 meatball subs, make a 20% profit, and then sell them. But now you can only buy 100 meatball sandwiches. You haven't increased your purchasing power. This is Warren Buffett talking to that point in 1979. He said, a few years ago, a business whose per share net worth compounded at 20% annually would have guaranteed its owners a highly successful real investment return. Now, such an outcome seems less certain, for the inflation rate, coupled with individual tax rates, will be the ultimate determinant as to whether our internal operating performance produces successful investment results, i.e., a reasonable gain in purchasing power from funds committed for you as shareholders. Just as the original 3% savings bond, a 5% passbook savings account, or an 8% U.S. Treasury note have, in turn, been transformed by inflation into financial instruments that chew up, rather than enhance purchasing power over their investment lives. A business earning 20% on capital can produce a negative real return for its owners under inflationary conditions, not much more severe than what presently prevail. This occurred in 1979 when the inflation rate was 11%, so it's incredible. When considering assets from the standpoint of purchasing power, the 3% savings bonds, high-interest bank accounts, and even 8% guaranteed treasury bonds are all options. Obviously, we don't get that anymore. But back then, it was still a loss of purchasing power for investors. Buffett says the combination, the inflation rate plus the percentage of capital that must be paid by the owner to transfer into his own pocket the annual earnings achieved by the business, i.e., ordinary income tax on dividends and capital gains tax on retained earnings, can be thought of as an investor's misery index. When this exceeds the rate of return earned on equity by the business, the investor's purchasing power, real capital, shrinks even though he consumes nothing at all. As a result, inflation in a bad time for investors, because we can think about the annual percentage lost of purchasing power when we consider the rate of inflation. And then there's the tax you have to pay on the dividend income, as well as the capital tax, capital gains tax you have to pay when you sell. Even if the firm succeeds well, your real return on investment may be negative. Buffett offered this example in 1980, which I really enjoy. He spoke, the advantage tax-paying investor is now running up a down escalator, whose pace is accelerated to the point where his upward progress is nil. But beyond being an investor, inflation can be a crappy time for businesses as well. Obviously, inflation eats away at their purchasing power as well. Now, businesses generally need to buy a lot of stuff to keep operating if this stuff is now all of a sudden more expensive. They're stuck in a bind since they have to pay the greater operating cost. As a result, they either generate a less profit or try to boost prices in the hopes that their sales volumes does not decrease. Interest rates may be pushed up as a result of its inflation. This could make it more difficult for businesses to obtain loans or make existing loans more expensive to repay. This makes it far more difficult for investors like you and me to find fantastic stocks that will compound our money over time. This is Warren Buffett's analysis of which kind of businesses do well even when inflation is high. He says, such favored business must have two characteristics. Number one, an ability to increase prices rather easily, even when product demands is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume. Number two, an ability to accommodate large dollar volume increases in business, often produced more by inflation than real growth, with only minor additional investment of capital. Number one, it makes reasonable to be able to raise prices without facing any penalties, right? Higher costs are affecting the company's profit margins. So, if you can pass those additional costs on to the customer, that is absurd. No corporation could do such a thing. People would simply purchase a cheaper product elsewhere, but not if the business is protected by a moat. You're a tiny production firm with 50 employees who have all been trained in Photoshop, Premiere Pro, and After Effects. It took some time. It also cost money. Adobe suddenly says subscription now $10 more per month. Cop it. And you say that's it, let's switch to a cheaper alternative. Maybe you find a cheaper alternative, $20 a month cheaper. Great, but it doesn't have all the same features as what the team's already using. Plus, it's going to cost $200 per employee to train them on the new software, not to mention the downtime your business will experience to get that training done and to switch everybody over. Then, you think about the clients. The clients are already stressing you out. They're trying to get their productions finished. And at the end of the day, it's just not worth switching. So, what do? You just pay more. You stick with Adobe, you just pay more. And another real-world example, Apple has such a strong brand mode and a strong ecosystem that it's completely normal for them to squeeze a little bit more and a little bit more out of all their customers each year. In 2012, iPhone average selling price was just over $600. At the end of 2018, it was almost $800. I'm sure now it's even higher. And that's not even considering the plethora of add-on subscriptions Apple will more or less force upon you, whether it be Apple Care or iCloud or Apple Music. There is no way out, which is precisely the point. During inflationary periods, seek for companies with wide moats that can raise prices without causing harm. Second, you want the company to be able to accommodate huge dollar volume growth in business with only modest additional capital investment. So, if you can't pass on additional costs to the customer, you'll have to bear them yourself, resulting in decreased profit margins. So, if you want to make the same or more money with lower margins, you'll need to expand the amount of business you do. Essentially, what Buffett is saying here is you want companies that are growing and are also pretty scalable. For example, a shipbuilding company would struggle on this point. It costs a lot to build a big ship. You're not going to make huge margin doing it. But it's also very hard to increase the number of ships you're churning out each year. That would take huge, enormous investments into new shipyards, and it'll be really slow to wind up. But then, if you consider a company like Facebook, on the other hand, if they aren't able to pass on the extra cost to their customers, which are the advertisers, They could just choose to bump up the frequency of sponsored posts or of other ads. So, when you're scrolling Instagram, you see 3 ads instead of seeing 2. And they could do that very, very easily and very quickly as well. So, that's the second characteristics that really help your business thrive even through periods of inflation. Ability to ramp up their business so the lower margins actually don't have an impact of the financials. But Buffett has one more piece of advice for those seeking the best strategy during a time of inflation, because sometimes there's just no escaping that stock market investing in these times can be really hard. Have a listen to this. But given the fact that we're dealing with fairly high levels of inflation in India, what would your advice be to people who are investing? What should they change? What should they do? Yeah, well, Inflation Kane said it many years ago that it's an invisible tax that only one man in a million really understands, and it's a tax on people that have had faith in their currency. That the governments issued that the best protection, the best investment against inflation is to improve your own earning power. You know your own talents. Very few people maximize their talents, as if you increase your talents, they can't tax it while you're doing it. Then they can't take it away from you. So, if you become more useful in your activities, your profession, doctor, lawyer, whatever it may be, that is the best protection against a currency that might decline at a rapid rate. And the best investment, passive investment, I think is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency. Buffett is implying in this clip that it is difficult to achieve. As a stock market investor, when inflation continues to rise, it's a tough moment, and your true return could be nil. So it's probably a better idea to invest in yourself, to improve your skills so that you may earn more money and keep your personal purchasing power. If you can keep your personal purchasing power, you can make yourself more valuable. When inflation levels down, you'll still be a good position to invest, and you'll probably be able to find some bargain stocks. Overall, that is how the great man Warren Buffett suggests that we should invest during inflationary times. It all boils down to competitive advantage. If your organization has a moat and can raise prices without suffering bad consequences, then such enterprises are the ones that win. They come out on top during inflationary eras, and the reason for this is that everyone else loses so much. So, which investment tips of Warren Buffett have you found to be particularly beneficial? Please let me know in the comments section below, and if you like this video, please give it a thumbs up, turn on the notification bell, and subscribe to our channel for more. Thank you for taking the time to watch. Stay tuned for our next video.